Okay, thanks very much for your time. It's a privilege to talk to you. My name's Shawn Burns, as Peter said. I'm the portfolio manager for the Switzer Dividend Growth Fund and also Contango Income Generator Fund. And I'm going to talk about the latter today and specifically about investing in yield funds outside of the top 30 stocks by market capitalization, so going into the mid-sized companies. Just give you a second to look at the disclaimer and then onto what we're talking about here. So this is the Australian market by market capitalisation split into by size. So, and the largest companies you'll see on the right, that greyish piece is the top 30 companies by size. So they're huge, right? They're 62% of the whole market are in these. And what are we talking about here? We're talking about the big banks, Telstra, Woolies, Coles, Wesfarmers, etc. So BHP, the big companies. On the left-hand side, you see I've split this again in the remainder in the two pieces. Up the top, you have the non-yield stocks. So these are like companies which may be developing something. They may double, they may go broke. They're volatile. They haven't really got, a lot of them haven't got a lot of history. Their profits are up and down. They haven't paid dividends, etc. They're doing things. They're on a journey, and that could really work well or may not do. We don't invest in that area. So you see a lot of small miners there, some biotech type companies, which could do well or could not do. What we invest in is that blue slice there, so about 18% of the market. What we're looking for are stocks with a track record of consistent dividend paying, businesses that we can understand that throw off a lot of cash, because that cash will keep paying dividends going into the future. So it's a part of the market, and it excludes those big companies like the big banks, etc. Just a little bit of portfolio theory here. If we took that large grey slice that we saw in the previous slide, that circle on the right is basically what you have a portfolio there. As Peter was saying before about Richo's portfolio, 4 large banks, Telstra, that's fairly typical type of retail shareholding. That has a lot of concentration risk in it. What we're trying to do here when we have Contango Income Generator is invest in a portfolio of stocks that ordinarily people probably won't know about that much or won't invest, but putting a portfolio together of 30, 40 stocks, combining it with your existing holding of those large caps, through diversification, reduces your risk without diluting the return. So that's the theory behind it. I'm going to now talk about a couple of stocks in the portfolio and why we hold them. And firstly, Charter Hall Group. Now, you can see, again, this is sort of an interesting stock price. So we've held it since inception all the way through, and we're still holding it now, a lower proportion than what we held back there. You can see that basically the company sort of did nothing for a long period of time there. It was yielding 5 or 6%. We knew the company quite well. We knew what they did. And then all of a sudden the share price has gone much higher. Now, what's happened there? As I said, we understand what the company does. It's fairly simple. It's in real estate. It raises fund and invests alongside. It develops, but not much. It's mainly a property fund manager. What we like about that is its ability, a proven ability to raise fund in. So it's able to get money and get clients and raise money and put that in there, buy properties and keep growing that pie. And what's happened to them, which has been a positive, lower interest rates has been a great boon for them. And that's happened because of 2 things. Firstly, when you're yielding 5 or 6% and growing, as interest rates fall, you become much more attractive. So that puts interest in your share price. Also, they're in property. And as interest rates have fallen, properties become more attractive. Those yields have been, people have been chasing them. And that's their client base, growing and throwing more money at them. So that's what we're saying. And also strong management. They're able to execute well, and that's what we're after So that's a good example of what we're doing. Another company is Babb Corp in the portfolio. This, again, interesting share price. You can see, and we've held this for quite a while as well, and this is a typical share price of what I'd call like industrial Australia, so mid-sized companies. You can see they were doing well during the resources boom, and there was certainly a lot of growth in Australia, and then flat for the last 2 years or so. So what we've had there, we've had various government inquiries like the Royal Commission and the Energy and Gas Commissions, electricity, and also the housing boom coming off. That's really flattened the outlook on a whole range of stocks. And what happens now going forward will be interesting as we're seeing interest rates come down. I mean, interest rates were probably too high during the resources boom. Now Australia's interest rates are coming down, and I think and tax cuts coming. So I think that companies like this will have a better future going forward over the next couple of years. Again, what are we looking for in these type of companies? We like good management. I mean, it's tough conditions out there. Good management makes the right decisions and avoids the wrong decisions. So when we're skewing the portfolio, we like to back people who we think will make those right decisions in tough times and not destroy value. Also, we like businesses that are reasonably resilient to downturns. And what I mean by that is if the economy slows a lot, their business doesn't fall apart. That's what we like, that they can rely that they will get repeat sales going forward. And Babb Corp basically is like, it falls into that category because people need their cars repaired, and it may slow at times and people push forward, delay that expenditure, but it does happen. So they are reasonably resilient. And it also has some growth prospects. They're rolling out new stores. So you see a combination of resilience and a little bit of growth. So that's why we like that. And there's a similar style stories across the portfolio. Now I'd like to talk a bit more about the portfolio, what it offers. It provides diversification away from the large cap companies. As I said, it blends in with them. Offers a higher yield than the market. We try and maximise the yield while keeping the risk as low as we can. Remember, we're getting into sort of mid to smallish size companies here, so managing risk is very important. So we target companies with lower volatility and balance sheet strength. So we look through and make sure that they have the cash flows. They haven't got convoluted structures that we don't understand where the cash is all coming from. And we know businesses that we can see and understand and see the cash coming through, which pays the dividend. And we measure that through the volatility of their earnings, volatility of the dividends, etc. And they have to have a history of paying dividends. And targets companies with moderately growing dividends, but also those, as I said, which we don't want them to suddenly pass their dividend, like pay a high dividend this year and nothing the next year. We avoid those type of situations. This is on our website. We report this every month. This is the top 10 holdings and the sectors currently. Just starting on the right, you can see up the top there, real estate, 19%. We put that position in about middle of last year. If you remember back there, we had the housing downturn coming. We had the Royal Commission in full flight. And we thought these things are getting pretty tough here. Interest rates could start falling. We need secure income, so we put a big position in the REIT sector, and we're happy we did. I mean, that's a good position. I think those type of companies pay consistent dividends. They don't vary very much. So we were buying 4, 5, 6% yields, and with slow growth, and we were happy about that. Also quite defensive in the environment at the time, and probably still is. And also we have, you can see utility sector, much the same, and a bit of cash. And the rest is spread. When we look at consumer discretionary, that's not really discretionary. That's what we'd call things like Babb Corp, sort of resilient discretionary. So we are spreading the risk across the portfolio. The top 10 holdings, again, you can see a lot of defensive type stocks there, like ASX, GPT, Stockland, Spark, etc. We've got Tabcorp, very defensive. They just reported a reasonable result yesterday, I think it was. A couple of the banks. And you can see that 4.4 down to 2.9 is a spread of stocks. There's another 30 stocks below that, which are calibrated down between like 3% and 1% holdings. So the point is you get a spread across sectors, you get a spread across stocks. So if we miss a stock and that suddenly something untoward happens, it doesn't undermine the whole portfolio. So what do you get in summary? What do you get when you invest in Contango Income Generator? The income is paid quarterly, so it pays a quarterly dividend. It's after high yield, so we want to try and get as much yield as we can without taking excess risk. So we're continually going through calibrating how much dividends, are they repeatable? Will they continue on into the future? Is there cash to back that? Diversify the portfolio and look through the cash flows of the companies to make sure that they're continuing. We do chase franking, and we've had a history of paying about 50% frank yield. That comes straight from the companies. We do value it when we look at companies specifically. We value gross yield, so we try and maximise our franking wherever possible. Again, if franking comes with excess risk, then it's not for us. As I've said earlier, it complements existing portfolios where you have a large holding of large cap stocks. This tries to get yield or targets yield outside of those large holdings. And also, and at the moment, like a lot of LICs, it's trading at a discount to pre-tax value. So we put in our latest monthly NTA statement a few days ago. You saw it was 96 cents. It's trading around 80 cents. So you're buying 96 cents worth of value for 80 cents. So that seems like a reasonable deal. But I would also say that, if we look at the Australian long bond, 10-year bond, Aussie bond, government bond, at under 1% at the trading today, to me that says that interest rates are staying low for a long time. So, it's worth you looking to see where you can get income from and sustainable, repeatable income into the future. So that's my slides. Thank you very much for that. Thanks very much for your time.